Something is changing inside the banking system, and most people will not notice it until the system touches their own money. That is usually how financial risk works. It does not begin with panic, it begins with rules, it begins with policy language, it begins with a regulator changing a framework, a bank changing a compliance process, a government changing a threshold, or a central bank testing a new tool. Then one day an ordinary person tries to move money, withdraw money, access an account, send a wire, hold cash, hold a foreign asset, or use a dormant balance, and suddenly discovers that ownership is not as simple as it felt. That is the part people misunderstand. They think the money in a bank account is just money sitting there under their name emotionally. That is how it feels. But legally and operationally, a bank deposit exists inside a system of contracts, deposit insurance limits, banking laws, capital rules, tax enforcement rules, anti-money laundering rules, sanctions rules, privacy rules, dormant account rules, and emergency powers. When the system is calm, these rules are mostly invisible. When stress appears, the rules become very visible. This is why I do not think about banking safety in emotional terms. I think about it in systems terms. Where is the money? Who controls access? What are the limits of insurance? What happens if the bank fails? What happens if the account is inactive? What happens if a government decides there is financial stress? What happens if a bank's compliance system flags a transaction? What happens if cash use becomes restricted? What happens if the currency itself loses purchasing power? These are not conspiracy questions, they are risk questions. And anyone who has spent time studying debt cycles, banking crises, currency debasement, capital controls, and financial regulations knows that the most dangerous risks are often the ones that seem impossible until they happen. The modern banking system is built on trust, but trust does not mean the absence of rules. Trust means you understand the rules well enough to know what can happen. That is why I want to walk through the changes that are causing concern among people with meaningful assets. Not to create fear, but to create clarity. Fear without clarity is dangerous. Clarity without fear is useful. The first major issue is the shift from bailouts to bail. For most of modern history, when people thought about a major bank failure, they assumed the government would step in a crisis, the state would protect the system, stabilize the bank, and use public funds if necessary. That was the bailout model. The 2008 financial crisis changed the public tolerance for that model. Governments spent enormous amounts of money supporting the financial system. Many taxpayers believed they were being forced to rescue institutions that had taken excessive risk. Regulators then asked a logical question: if another large bank gets into trouble, can the losses be absorbed inside the financial system instead of being pushed immediately onto taxpayers? That is the logic behind bail. In's a bail. In means that when a bank becomes insolvent or faces severe losses, certain stakeholders inside the bank can be used to absorb those losses. First, shareholders are hit, then certain bondholders and creditors. Then, in severe circumstances, large uninsured depositors can become exposed. That last part is what most people do not understand. A bank deposit above the insured limit is not riskless. It is technically an unsecured claim against the bank. In normal times, that distinction does not matter. In a crisis, it can matter a great deal. In the United States, the standard deposit insurance limit is $250,000 per depositor. Per insured bank, per ownership category. Other countries have their own limits. The exact number varies, but the principle is the same. The insured portion has a government backstop. The uninsured portion is different. People with large deposits often assume that because the balance shows up in an account, it is fully protected. That is not always true. If a banking crisis becomes severe enough, laws in many major jurisdictions allow losses to move through the financial structure in ways that most depositors have never seriously studied. This is not a prediction that every large depositor will lose money. It is a reminder that the legal structure exists. A resilient banking strategy begins with knowing what portion of your money is insured, what portion is not, and whether you are unnecessarily concentrated at one institution. The principle is simple. Do not let convenience become concentration risk. Many wealthy people and businesses keep too much cash in one bank because it is easier. One login, one relationship manager, one wire process, one operating account. That convenience can hide fragility. If the money is far above the insured limit, you should understand the exposure. You may decide the bank is strong enough. You may decide to spread deposits. You may use different account ownership categories. You may use treasury bills, money market structures, custodial platforms, or multiple institutions depending on your situation. The specific answer depends on facts. The principle does not. Know the rules before stress tests them for you. The second issue is dormant accounts. This sounds boring, which is why people ignore it. But many risks hide in boring rules in many countries. If an account sits inactive for a long enough period, it can be classified as dormant. Once that happens, unclaimed property laws or dormant asset rules can allow the funds to be transferred to the state. In some places, the dormancy period can be only a few years. In others, it may be much longer. Some jurisdictions make a strong effort to locate the account holder or heirs before transferring funds. Others move faster. Some systems are fairly easy to reclaim from. Others can be bureaucratic, slow, and frustrating. The concern is not only that dormant account laws exist. The concern is that in some places the timeframes have been shortened or expanded to include more asset types. A person may assume that if money sits quietly in a bank account, it is safe, but if the account has no activity, no communication, no updated address, and no clear contact trail, the system may eventually treat it as abandoned. This matters for people with multiple accounts, elderly parents, offshore accounts, inherited accounts, old insurance balances, forgotten investment accounts, and accounts opened in another country. Again, the solution is not panic. The solution is administrative discipline. Keep a list of accounts, keep contact information updated. Log in periodically, make small legitimate activity when needed. Tell trusted heirs where accounts exist. Keep beneficiary information current. Do not let important assets become invisible simply because you forgot to create a system around them. Most financial disasters are not caused by one dramatic event. Many are caused by neglect. Dormancy is a neglect risk. The third issue is civil asset forfeiture and account freezing. Most people believe assets can only be taken after a criminal conviction. That belief is emotionally satisfying, but in many legal systems it is incomplete. Civil asset forfeiture rules can allow authorities to freeze or seize assets before a criminal case is fully resolved. These tools were created to target organized crime, corruption, money laundering, and proceeds of crime. The purpose may be legitimate, but the process can still create risk for ordinary people when legal thresholds are low, when investigations take a long time, or when the burden of fighting becomes expensive. In the United States, civil asset forfeiture has been used for many years. In the United Kingdom, unexplained wealth orders can force people to explain the source of wealth. Australia and Canada have similar frameworks connected to proceeds of crime. The important point is not that everyone will be targeted. That would be wrong. The important point is that assets can be frozen long before a matter is fully settled. During that time, access can be limited or unavailable. Even if the person eventually proves everything, the process itself can create damage. If your money is frozen for months or years, the fact that you are innocent does not pay your bills during the freeze. That is a systems problem. So the protective principle is to make your wealth explainable, clean documentation, clear source of funds, tax compliance, business records, contracts, inheritance records, sale records, professional advice when needed. The more your money can be explained, the less vulnerable you are to confusion. A person with unclear records may still be innocent, but he has more risk. A person with clear records can answer questions more quickly. In a world of stronger monitoring and enforcement, documentation is not paperwork. It is protection. The fourth issue is capital controls. Many people believe capital controls only happen in developing countries. History says otherwise. Capital controls can appear when a country faces severe financial stress, banking panic, debt crisis, currency pressure, or capital flight. They may limit withdrawals, they may restrict international transfers, they may block or limit foreign currency conversion, they may prevent money from leaving the country freely. During the Cyprus banking crisis in 2013, depositors faced withdrawal limits and transfer restrictions. During the Greek debt crisis, ATM withdrawals were capped. Iceland imposed strict capital controls after its banking collapse and kept restrictions for years. These were not imaginary events. They happened. The principle is that when a financial system is under severe stress, governments may decide that the stability of the system matters more than the individual's ability to move money freely. You may disagree with that. You may think it is unfair, but the system can still impose it. That is why wealthy people in countries with higher political currency or banking risk often keep some assets in strong foreign jurisdictions before a crisis begins. Once capital controls are imposed, it may be too late to move money out. This does not mean everyone needs a foreign bank account. It means you should understand jurisdiction risk. Where your money is located matters. The law governing the account matters, the currency matters, the bank matters, the country's debt cycle matters. Its political stability matters, its treatment of private property matters. Its history during crises matters. A bank account is not only a balance, it is a balance inside a jurisdiction. That is the deeper point. The fifth issue is investment and asset restrictions. Governments increasingly shape what citizens can hold, how they can hold it, and what reporting obligations apply. Sometimes these rules are justified by tax enforcement, sometimes by anti-money laundering concerns. Sometimes by consumer protection, sometimes by financial stability, sometimes by political pressure. Examples can include complicated tax treatment of foreign mutual funds, caps or restrictions on certain stablecoin exposures, reporting requirements for crypto, scrutiny of foreign currency accounts, and rules around gold transactions. Each rule may have a stated reason, but the combined effect can be that individuals have less freedom in how they allocate their own money. This is a subtle kind of risk because it does not necessarily freeze your account, it narrows the set of choices available to you. It can make certain assets expensive to hold, difficult to report, or impractical for ordinary investors. A resilient investor pays attention not only to market risk but also to regulatory risk. An asset can be attractive economically and still create legal, tax, or administrative complexity. That does not mean avoid everything outside the most familiar system. It means understand the rules before you buy. A foreign fund may have different tax treatment, a crypto asset may have reporting and custody risk, a gold transaction may have documentation requirements, a foreign currency account may create filing obligations. The more global and complex your financial life becomes, the more important it is to build it deliberately rather than casually. The sixth issue is currency debasement and the future of central bank digital currencies. Currency debasement is not always dramatic. It often happens through the quiet erosion of purchasing power. When the money supply expands faster than the productive capacity of the economy, and when inflation exceeds the interest paid on deposits, savers lose real value. Their account balance may look stable, but what the balance can buy declines. This is why inflation is such a dangerous tax. It does not arrive as a bill. It arrives as higher prices. Many people feel safe because they have cash in the bank. But if that cash earns little while prices rise, the real value of the cash is being reduced. That is not banking failure. That is purchasing power failure at the same time. Central banks around the world are exploring central bank digital currencies. The future use of CBDCs remains debated. They may be designed in different ways. Some may be limited to wholesale financial settlement. Others may be more directly connected to consumers. The concern is not simply that money becomes digital. Most money is already digital in practical terms. The concern is programmability. In theory, digital central bank money could allow new tools, negative interest rates, spending restrictions, targeted stimulus, expiration features, demographic targeting, or more direct monitoring of flows. Whether these things will be used broadly is uncertain, but the fact that such tools become possible is enough for serious investors to think about diversification. This is not about assuming the worst. It is about recognizing optionality. If the monetary system becomes more programmable, people who hold all their liquidity inside one currency and one banking system may have less flexibility. People who diversify across assets, institutions, currencies, and jurisdictions may have more. The principle is to avoid single system dependence. The seventh issue is tax authority freezing and cross-border enforcement. Every developed country needs to collect taxes. Tax enforcement is not inherently wrong, but tax agencies in many countries have broad powers to freeze accounts when taxes are unpaid or when they believe a taxpayer is not cooperating. Through international agreements, information exchange, FATCA-type rules, and treaty networks, tax authorities can often obtain financial information across borders. For honest taxpayers, the issue is not evasion. The issue is aggressive enforcement, mistakes, misunderstandings, or investigations that freeze funds while the facts are being sorted out. If you have international accounts, foreign assets, foreign businesses, or cross-border income, compliance matters enormously. You need proper reporting. You need records. You need professionals who understand the relevant jurisdictions. You need to avoid the amateur mistake of believing that because money is offshore, it is invisible. That is not how the modern system works. The modern system is increasingly transparent. A stronger strategy is not secrecy. A stronger strategy is compliant diversification. There is a big difference. Secrecy creates fragility. Compliant diversification creates resilience. If a tax claim is legitimate, it must be dealt with. If a claim is mistaken, good records and proper structure help you respond. Certain jurisdictions may require stronger legal processes before enforcing foreign claims, while others may cooperate more quickly. That difference can matter, but the foundation is still compliance. If you are doing things properly, your structure should be explainable. The eighth issue is transaction monitoring. This is one of the most important changes because it affects nearly everyone. Banks already monitor account activity under anti-money laundering laws. They file suspicious activity reports and equivalent reports in different countries. These reports can be triggered even when a transaction is below a formal threshold. This is where many people have a false sense of safety. They think, if I stay under $10,000, nothing is monitored. That is wrong. Modern monitoring is behavioral. It looks at patterns, destinations, velocity, counterparties, unusual activity, international transfers, cash withdrawals, and deviations from expected behavior. Increasingly, artificial intelligence and automated systems can process more data faster than before. The issue is not only what gets reported, the issue is what gets flagged. If your bank sees activity that does not match your profile, it may ask questions. It may delay a wire, it may freeze an account temporarily while compliance reviews the situation. In some cases, people have experienced long delays even when no wrongdoing occurred. This is very important for people who need to move significant money. A person who regularly sends large international wires through a bank accustomed to that activity may experience less friction. A person who suddenly sends a large unusual wire through a bank that is not used to that profile may trigger more review. That does not mean one person is doing something right and the other is doing something wrong. It means the bank's systems treat them differently. This is why banking relationships matter. If you have a simple retail bank account but you need to conduct complex high-value or international transactions, the bank may not be the right fit. You may need an institution that understands your profile. Again, the principle is fit. Your bank should fit your life. If you have international activity, choose a bank comfortable with international activity. If you hold significant assets, choose an institution used to serving significant assets. If you send large transfers, make sure the bank understands and documents the nature of your transactions. If you operate businesses, do not use personal accounts in ways that confuse the compliance profile. Clean alignment reduces friction. Misalignment creates risk. The ninth issue, even if it is sometimes skipped over in the way people explain these rules, is broader information sharing and financial transparency. Banks are increasingly connected to regulators, tax authorities, other financial institutions, sanctions databases, identity verification systems, and behavioral monitoring tools. The boundary between one institution's knowledge and the broader system's knowledge is not as private as many people assume. When banks share risk signals, when regulators centralize data, and when compliance systems grow more automated, your financial activity becomes part of a larger information network. Again, this is not automatically bad. It can prevent fraud, money laundering, terrorist financing, tax evasion, and scams. But it also means errors can propagate. If one bank decides your profile is risky, another bank may ask questions. If a transaction pattern is misunderstood, the misunderstanding can create more friction than expected. If documentation is weak, the system may not give you the benefit of the doubt. That is why the solution is not to hide. The solution is to be legible. The financial system is becoming more transparent. You should respond by making your legitimate activity easier to understand. The 10th issue is de-risking. Banks sometimes close accounts not because the customer committed a crime, but because the customer no longer fits the bank's risk appetite. This can happen to people with large international transfers, cryptocurrency, related activity, politically exposed status, businesses connected to certain countries, unusual cash activity, or profiles that require extra compliance work. From the bank's point of view, de-risking can be rational. If a customer creates too much compliance burden relative to profit, the bank may close the account rather than investigate every detail. From the customer's point of view, it can feel arbitrary and unfair. Both things can be true. Banks are not public utilities in the way people emotionally imagine them. They are regulated institutions with risk models, compliance costs, and incentives. If your profile does not fit, they may decide they do not want the relationship. That is why serious clients often choose banks that align with their profile from the beginning. If you are an international person, use an internationally capable bank. If you have crypto-related activity, use institutions that clearly permit and understand that activity. If you are politically exposed, use institutions with proper processes for that profile. If you have complex wealth, use banks accustomed to complex wealth. Trying to force a complex financial life into a simple retail banking mold can create problems. Again, this is not about hiding anything. It is about fit documentation and resilience. The 11th issue is restrictions on physical cash. Cash is becoming harder to use in many places. Some countries have introduced legal limits on cash payments. Some businesses do not want to accept cash because banks, card networks, insurers, and compliance systems make cash handling inconvenient. In some countries, cash remains legally available but practically less usable. This trend is strongest in parts of Europe, but it is not limited to one region. The move away from cash is often justified by convenience, tax enforcement, anti-money laundering rules, safety, and efficiency. Those arguments are not meaningless. Digital payments are convenient. They create records, they reduce some types of crime. But cash also represents privacy, direct settlement, and the ability to transact when digital systems fail, when cash use becomes restricted. Individuals lose one form of optionality. For ordinary people, this may not seem important until there is a crisis, an outage, a bank freeze, a payment network disruption, or a policy restriction. The principle is not that everyone should hold large amounts of cash that can create its own risks. The principle is that financial freedom depends partly on having multiple ways to access and use money. If every path runs through one digital system, one bank, one currency, and one jurisdiction, you are more fragile. Now let us bring all of these issues together. Bail-ins, dormant account rules, civil asset forfeiture, capital controls, investment restrictions, currency debasement, CBDC possibilities, tax authority freezes, transaction monitoring, information sharing, de-risking, cash restrictions. Each issue is different, but they share one underlying theme. The individual has less unconditional control over money than most people assume. That does not mean you do not own your money. It means ownership operates inside a system. The system has rules, limits, intermediaries, and emergency powers. If you understand those rules, you can structure your financial life more intelligently. If you ignore them, you may be surprised at the worst possible time. This is why wealthy people often think differently about banking than ordinary people. Ordinary people ask, which bank has the best app, the highest savings rate, or the nearest branch? Wealthy people ask, where is my money legally located? What is my counterparty risk? What is insured? What is uninsured? What jurisdiction governs the account? What happens in a crisis? Can I move money internationally? What is the bank's attitude toward my type of activity? What documentation do I need? What happens if I am investigated, sued, or subject to a tax inquiry? Can my heirs access the account? Is the account active and recorded? That is a very different level of thinking, and you do not need to be extremely wealthy to use the principles. The first protective principle is diversification across institutions. Do not keep all meaningful deposits in one bank if they exceed insurance limits. Understand coverage rules, consider multiple banks, account categories, or low risk alternatives depending on your situation. The second protective principle is diversification across jurisdictions when appropriate. Not everyone needs offshore accounts, but people with significant assets, international family, international business, political risk, currency risk, or concerns about capital controls may benefit from having money in a stable foreign banking jurisdiction. This must be done legally and transparently. The point is not to avoid taxes. The point is to reduce single country dependence. The third protective principle is documentation. Every significant source of funds should be explainable. Every major transfer should have a purpose. Every account should have records. Every international structure should be compliant. Every tax obligation should be understood. Documentation turns suspicion into explanation. The fourth protective principle is account activity and estate visibility. Do not let accounts become dormant. Keep records of where accounts are. Update contact details. Maintain beneficiary designations. Let trusted people know enough to find assets if something happens to you. The fifth protective principle is bank profile alignment. Use banks that understand your activity. Do not run complex international or business transactions through a bank that is uncomfortable with them. Do not surprise a bank with large, unusual flows if you can communicate in advance. The sixth protective principle is liquidity outside one channel. If all access depends on one account, one card, one country, and one payment system, you have a point of failure. Maintain backup access. Maintain more than one banking relationship. Maintain some practical liquidity for emergencies. The seventh protective principle is to preserve purchasing power. Bank safety is not only about whether the bank fails, it is also about whether the currency loses value. Think about productive assets, hard assets, global assets, and inflation-aware planning. Cash has a role, but cash is not a complete wealth strategy. The eighth protective principle is compliance. This is non-negotiable. The modern world is too transparent for hidden structures, careless reporting, or casual cross-border behavior. If you diversify globally, do it with proper legal and tax advice. File what must be filed, report what must be reported. Keep records. A legal structure protects you, a hidden structure endangers you. The ninth protective principle is to avoid panic narratives. Some people use banking risk to sell fear. Others dismiss all banking risk as paranoia. Both extremes are unhelpful. The better approach is to think like a risk manager. What can happen? How likely is it? What would the damage be? What simple steps reduce the damage? What is worth doing now before stress appears? That is how serious people think. If you study history, you see that financial systems can look stable for a long time and then become restrictive quickly. During stress, governments and banks often act fast. Capital controls can appear suddenly. Account freezes can happen with little warning. De-risking letters can arrive unexpectedly. Compliance reviews can delay transactions just when funds are needed most. The goal is not to predict the exact crisis. The goal is to remove unnecessary fragility before any crisis. That is the same principle I apply in investing. You do not know which shock will come. You know shocks will come. So you build a system that can withstand them in banking. That means avoiding concentration, understanding insurance, keeping clean records, using appropriate institutions, maintaining access, and diversifying legally. This is not dramatic, but many important protections are not dramatic. They are boring until they matter. Insurance is boring until the loss. Documentation is boring until the audit. Multiple banks are boring until one account is frozen. Foreign access is boring until capital controls. Cash alternatives are boring until payment systems fail. Beneficiary records are boring until heirs need them. The work you do before a problem is the work that determines how painful the problem becomes. Now, I want to address an emotional issue. People do not like hearing that banks can restrict access, governments can impose controls, or rules can change around their money. They feel that if they earn the money, paid taxes on it, and deposited it legally, access should be absolute. I understand that feeling. But reality is more complicated. A bank is not a vault with your specific bills sitting inside. It is a leveraged financial institution. It takes deposits, makes loans, invests assets, complies with regulators, and operates inside a legal framework. Your deposit is part of that system. A country is not only a place where you live, it is a jurisdiction with laws, debts, politics, currencies, enforcement agencies, and emergency powers. A currency is not only a unit of account, it is a policy tool managed by a central bank and government debt system. If you understand those realities, you can protect yourself better. If you deny them because they feel uncomfortable, you become more vulnerable. This is one of the most important principles in life. Reality is not required to be pleasant before you respond to it rationally. You do not have to like bail in rules to understand deposit insurance. You do not have to like dormancy laws to keep accounts active. You do not have to like civil forfeiture to keep documentation. You do not have to like capital controls to diversify jurisdictions. You do not have to like transaction monitoring to make transfers clean and explainable. You do not have to like currency debasement to own assets that can preserve purchasing power. You do not have to like cash restrictions to build backup payment options. You only have to adapt. Adaptation is survival. This does not mean moving everything to Switzerland, Liechtenstein, Monaco, or any other traditional banking hub. Those jurisdictions may have stronger traditions around asset protection, privacy, and long-term banking relationships. But they are not magic. They still have laws. They still comply with international rules. They still require proper documentation. They still freeze assets when valid legal orders exist. The value of a strong jurisdiction is not that it lets you ignore the law. The value is that it may have stronger process, stronger property, right traditions, more experience with wealth, and less arbitrary behavior. But the foundation remains the same: legal money, clear records, compliant reporting, appropriate structure, good advice. This is how resilient wealth is built. Not by hiding, by structuring. There is also a difference between privacy and secrecy. Privacy is legitimate. It means your affairs are not unnecessarily exposed. Secrecy often means trying to avoid lawful disclosure. In the modern financial system, secrecy is fragile. Privacy supported by compliance is more durable. That is the balance serious people try to find. Now, for an ordinary person, what should be done? Start with the simplest steps. Know your bank deposit insurance limits. If you hold more than the insured amount, decide whether that is intentional. Keep a list of all bank accounts and investment accounts. Make sure they are active. Update addresses, phone numbers, and email contacts. Keep beneficiaries current. Keep copies of account statements. Avoid leaving old accounts forgotten. If you make large transfers, document the purpose. If you send money abroad, know the reporting rules. If you receive large sums, keep source of funds records. If you operate a business, separate business and personal accounts. If your profile involves crypto, international transfers, political exposure, or unusual activity, choose banks that understand that profile. If you have meaningful wealth, consider whether one jurisdiction is enough. If you have elderly parents, help them organize their accounts before memory or health issues make it harder. If you are holding large amounts of idle cash, think about purchasing power risk. If you are worried about a policy change, do not wait until the policy is implemented to act. Preparation before restrictions is easier than reaction after restrictions. That is true in every crisis. The issue is not whether every one of these banking changes will affect you directly. Many may not. You may never experience a bail, and you may never face capital controls. You may never have an account frozen. You may never deal with civil forfeiture. You may never use a CBDC in a restrictive way. You may never be de-risked by a bank. But risk management is not based only on what is most likely. It is also based on what would be very damaging if it happened. A low probability event with high damage deserves some preparation if the preparation is simple and reasonable. Spreading deposits is not extreme. Keeping records is not extreme. Maintaining more than one banking relationship is not extreme. Understanding your jurisdiction is not extreme. Staying compliant is not extreme. Protecting purchasing power is not extreme. These are basic principles. The problem is that people often wait until they are wealthy to think about them. But by then the habits are already formed. It is better to build the habits early. Banking resilience is not only for billionaires, it is for anyone who wants control over their financial life. Control does not mean total freedom from rules. Control means knowing the rules, planning around them, and reducing preventable points of failure. If I were to reduce the entire issue to one sentence, it would be this: do not confuse a bank balance with unconditional access. A balance tells you what the account says. Access depends on the system. Insurance limits, bank solvency, compliance reviews, dormant account rules, legal claims, tax agencies, capital controls, payment restrictions, currency value, and cash rules all affect access in different ways. Once you see that, the old casual approach to banking looks incomplete. The modern world requires more deliberate banking. That does not mean fear. It means design. Design your banking like you would design a portfolio. Diversify, understand counterparties. Avoid concentration, maintain liquidity. Control duration and currency exposure, know the legal environment. Keep Keep records, stress test assumptions, use the right institutions for the right purposes, review periodically. This is how sophisticated people think. They do not ask, is this bank famous? They ask, what role does this account play in my overall system? One account may be for daily spending. One may be for emergency liquidity. One may be for business operations. One may be for insured savings. One may be for foreign currency access. One may be for international investment. One may be for long-term custody. Each role has different requirements. The mistake is using one account for every role. One account cannot solve every risk. One country cannot solve every jurisdictional issue. One currency cannot solve every purchasing power problem. One institution cannot be the entire plan. That is the core principle. Now, I do not want this to sound more complex than it has to be. For many people, the first 80% of improvement is simple. Stop holding too much uninsured cash at one bank. Stop ignoring old accounts. Stop making large, unexplained transfers. Stop mixing personal and business activity. Stop assuming cash is always easy to use. Stop assuming the bank will always understand your situation. Stop assuming the government will never restrict flows. Stop assuming inflation is harmless because the number in the account does not fall. Stop assuming that because something has never happened to you, it cannot happen. These are mental shifts. They create better behavior, and better behavior reduces risk. The most dangerous financial problems are often the ones people thought were too boring to study. Banking rules are boring. Deposit insurance is boring. Dormant asset rules are boring. Compliance monitoring is boring. Tax treaties are boring. Capital controls are boring until they happen, then they become everything. That is why serious investors study boring things, because the boring things often determine whether the exciting parts of wealth can be preserved. There is no point making good investments if your cash management is fragile. There is no point building wealth if your heirs cannot find it. There is no point earning returns if currency debasement destroys purchasing power. There is no point having international opportunities if your money is trapped by capital controls. There is no point having legal assets if you cannot explain them when asked. There is no point having a bank if the bank does not fit your transaction profile. This is a systems problem, and systems problems require system solutions. The solution is not one product. It is not one country. It is not one bank. It is not one gold coin. It is not one crypto wallet. It is not one fear-based decision. It is a structure that says, I know where my money is. I know which rules apply. I know what is insured. I know what is uninsured. I know how to access liquidity. I know how to prove source of funds. I know what happens if one institution creates a problem. I know who my advisors are. I know my heirs can find the accounts. I know my tax reporting is clean. I know my currency risk. I know my jurisdiction risk. That is resilience. Most people do not have that. They have accounts. Accounts are not the same as a plan. A plan anticipates stress. If 2026 brings more banking rule changes, more monitoring, more restrictions, more digital currency development, more enforcement, and more pressure on cash, the people with a plan will adapt much more easily than people who are surprised. That is why this matters. Now, before the account is frozen, before the bank fails, before the government imposes a control, before the currency loses more purchasing power, before the old account becomes dormant, before the bank decides your profile is too risky, before your heirs have to search for what you never organized, before a compliance officer asks for documents you never kept, the right time to build resilience is before you need it. That is true for portfolios. It is true for businesses. It is true for countries, and it is true for bank accounts. I will close with the most important point. Your money should not depend on one door. If there is only one door between you and your money, you are more fragile than you think. One bank is one door. One country is one door. One currency is one door. One payment system is one door. One access method is one door. One undocumented explanation is one door. A resilient system has multiple doors. It has legal clarity. It has documentation. It has diversification. It has backup access. It has properly chosen institutions. It has a plan for heirs. It has an inflation strategy. It has jurisdictional awareness. That is not paranoia. That is prudence. The banking system is changing. Some changes are already here. Others are developing. Some will be mild. Some may become serious only in periods of stress. But the direction is clear enough. More monitoring, more reporting, more restrictions, more digital control, more compliance pressure, more responsibility on the individual. To prove that his money is clean, active, documented, and properly structured, you can complain about that or you can adapt to it. I prefer adaptation because in the end, wealth is not only about making money, it is about keeping control over it. And in a changing banking system, control belongs to the people who understand the rules before the rules are used against them.